has chipped away at the pressure's prior gains and at the time of this report trades around $19.85 level, remaining near last week's closing range. Following signs of increased economic activity, yet heightened fears of a recession, it appears that the shiny metal is moving in a sideways motion as the markets await further information. In this report, we aim to shed light on the catalyst driving precious metals price and assets future outlook. The mixed economic data stemming from the US has facilitated gold's descent, with the pressures gradually losing momentum. Last Thursday, the US Philly Fed Manufacturing Index came in much lower than expected, with the figure standing at -31.3, indicating of a continued deterioration of US manufacturing conditions further weakened the greenback, as the continued decline in manufacturing production further fueled fears of a recession. Following the Fed's best book released last Tuesday, the Philly Fed Manufacturing Index supported the Fed's statements that overall economic activity has remained relatively unchanged in recent weeks, with manufacturing activity being widely reported as flat or down even as supply chains continue to improve, heightened fears of a recession in the US economy. Gold, as a result, saw inflows as the bullion is universally considered to be a hedge against times of economic downturn due to its safe haven status. However, US PMI figures released on Friday paint a different picture as gold traders saw a U-turn in the markets, with fears of a recession being played down. The pressures saw outflows as the greenback strengthened, reversing its gains in the previous trading session. It would appear that the contradictory figures have sent gold traders in limbo, as the stronger than expected manufacturing, composite and services PMI figures could provide an indication that the Fed may continue with its rate hiking path, despite the alarm being sounded by the Fed's best book and the Philly Fed Manufacturing Index in regards to recession. Even though fears of an impending recession cloud the markets, the short-term outlook appears to be better than originally forecasted, which tends to provide support for the bullion ahead of this week's highly anticipated preliminary GDP rate for Q1 and crucial core PCE data. Furthermore, we highlight that the US Treasury 2-year and 10-year yields have declined the past week, given that the risk that the US will default on its debt has increased. Therefore, as the US treads closer to its debt ceiling limits, this has facilitated temporary inflows into the precious metal, as US Treasury bonds are considered to be less attractive alternative until the debt ceiling is raised by the legislative bodies. Hence, in the event that the progress is made and the US inches closer to the risk of defaulting on its debt, the door may open for further inflows into gold. Overall, as a result of contradicting financial releases and external political implication, it would appear that gold may continue hovering near the $2,000 key psychological level until the market has adequate information in order to reassess and readjust their outlooks. Finally, we also note that the FOMC has entered its blackout period, with no policymakers holding speeches until after the Fed's meeting next Wednesday. Thank you for watching.